Welcome back to the second part of chapter 8. If you'll remember, we worked through the operating budgets in our last video. So operating budgets are prepared for a period in time. So those are going to be our income statement, which we ultimately is aggregated from all of these other budgets that we prepare first. So we have to start with our sales revenue. Then we ask ourselves, how much production do we think that we're going to have? And then we make sure we have enough direct materials, direct labor, and overhead needed to support that level of production. Where it gets a little bit funky, right, is that production doesn't typically equal sales, right? Because a lot of people will want to have a certain percentage of direct materials left on hand at the end of the month and different things like that. So I would heavily suggest, if you have not reviewed your operating budgets lecture yet, that you start there. Because once we prepare all of our operating budgets and our income statement, then we are left to prepare financial budgets. Financial budgets really are saying, okay, here I understand my operating budgets. I understand how much I'm going to produce. I understand how much I'm going to need. And now I'm asking myself, how am I supporting that level of operation, right? So financial budgets typically are going to be pretty based on cash receipts, cash disbursements, because that ultimately allows us to prepare our pro forma balance sheet. Okay, and if you remember from Principles of Accounting 1, sometimes you call a balance sheet a statement of financial position. So we're going to be primarily concerned with the amount of cash that we have on hand, again, to make sure that we can support the level of production that we've determined that we are expecting to have based on our pro forma income statement from all of our operating budgets. So the cash budget consists of three main sections, which is going to be our budgeted cash receipts or collections, our budgeted cash payments or disbursements, and our cash borrowed or repaid. So, hey, do I have any debt financing? Okay, did I get a bunch of cash because I took out a loan from the bank? So here's an important relationship, right? And this should make sense. How much did I start with? Plus how much I received, less how much I paid out, plus or minus any borrowing or repayments of debt. That's going to get me my ending cash balance. Don't make this more complicated than it is. It's the exact same thing if you were to, I don't think people really do that these days, but like if you were to balance your checkbook, you're going to say, hey, how much cash was in my account on the 1st of July? How much did I receive probably from like an employer, right? What are my receipts here? How much did I pay out? What were my expenses for my mortgage, for my car payment, any student loan debt, things of that nature? Okay. How much I borrowed or repaid, which your student loan debt would probably fall into that category. All right. So remember, we're hanging out with Cliff Bar, and we are going to build out their budgeted cash receipts. So how much cash is Cliff going to be bringing in during the year? So our cash receipts is going to be based off of our sales revenue. And that should make sense, right? Because the amount of cash that I'm receiving from the general operations of my company is going to be heavily tied to the amount of products I am selling. So I'm going to go into my budgeted cash receipts and I'm going to grab my budgeted sales revenue. So what budget do I go to? Of course, I'm going to go to my completed sales budget. And I'm going to grab that sales revenue value and I'm going to pull it all the way over. Okay. So now where this gets a little bit funny is that we should remember from Principles of Accounting 1 that cash does not equal revenue, right? Because I have that kind of funny guy called accounts receivable. So that's when I provide a service to somebody and I've recognized revenue, but they haven't actually paid me in cash yet, right? So I debit my accounts receivable, I credit my service or sales revenue. The other thing that kind of throws a little bit of a wrench in the plan is when people, right, when a customer puts something on credit. So that's when they give me cash in advance of me performing a service or providing a sale revenue item to them. So we have to take into account of my total sales, what percent is actually collected in cash? Well, it tells me that I have 40%, which is collected in cash. Okay, so of my total sales revenue, I collect 40% or 0.4 in cash. And that's during the month of the, or, during the quarter of sale. So they're going to say I collect 40% of my sales directly on cash or in cash. They give me cash that day. So that means of my $216,000 that I have in revenue in Q1, well, I am not collecting 60% of it in that quarter, right? It tells me that of the 60% that's left over, I still am collecting some of that in the month or in the quarter. So that means I made a sale to somebody in January and they still pay me within Q1. They just pay me in February, right? So I collect 75% of the remaining 60% in the same quarter. So how do we show that mathematically? Of my 216,000, I have 60% remaining that I have not collected during this, or that I did not collect directly in cash at the point of sale. And I know of that, I am collecting 75% in the month or in the quarter of the sale. Okay, so I think sometimes what I see is that some people will want to just take this and not include this 0.75. But remember, there's nothing saying that these customers have to pay us within this quarter, right? Maybe they have a sale on March 30th and then they pay us on April 2nd. Well, that crosses quarter lines, right? So you have to make sure you're specifying how much is left over, right? How much is in credit, and then how much am I collecting during this quarter? So I'm going to pull that all the way through. Now it tells me, right, that the remaining 25% is going to be collected during the next quarter. Okay, so here the only value that we couldn't compute is this 30,000 right here. And why could we not compute that? Well, we couldn't compute that because it would be based off of what? Q4 of the prior year, and we don't have that information. So we're just plugging in 30 as a given value. But how do I calculate Q2? Well, what it's telling me is, hey, I am going to what? I am going to collect the remaining Q1 sales. How much do I have remaining? Well, I know I collected 40% on cash at point of sale. So I have that 60% that was in credit. And how much am I collecting the quarter after the sale? The remaining 25%. Okay. So now I can pull that all the way through. And I am going to add a sum here. So this allows me to calculate my budgeted cash receipts. Okay, so budgeted cash receipts is important because it is a component of our total cash budget. So here's an example, right? A screenshot of what we have just worked through. And now we're going to move on to our budgeted cash payments. So again, you have to remember from Principles of Accounting 1, we use something that is called accrual-based accounting. So with accrual-based accounting, we're going to be saying, hey, cash isn't always made or paid in the same period that the expense is incurred. Okay. Do you guys remember making like those accruals for salaries payable? Because like our employees worked a couple of days for us, but we don't pay them until Friday. So it crossed month end lines. We had to book an accrual. But we had to recognize the expense in the period that it was incurred. So we're really building on that principle. Okay. So in our example, what we're saying here, and I'm going to go to this budgeted cash payments budget that I have made. And we are saying, okay, that we purchase direct materials in the quarter, but we don't use it until next quarter. So I have a cash payment for direct materials, but I don't use it or recognize the expense until the next quarter. I purchase equipment, but I don't pay for it until next quarter. And when I recognize depreciation expense, that item is non-cash. So we have a lot of different assumptions that we need to make here in order to ultimately build out this budget. So the first thing that we start with building out our budgeted cash payments is we are basing our cash payments off of our budgeted raw materials purchases. Why do I start with that piece? Because it's telling me that 20% of my direct materials is paid for in the quarter that I purchased it. 80% is paid for in the quarter following the sale. And then manufacturing overhead, we have some information about depreciation expense. And then all other expenses are paid for in cash in the quarter incurred. This is a really important line because that tells me that my job gets a little bit easier once I take care of direct material purchases and this manufacturing overhead non-cash item. Okay, so what we need to do here is we need to pull through our budgeted cost of raw materials purchases. Now, what budget should I go to plug this in? Well, I should, of course, go to my direct materials purchases budget. So I have my completed DM purchases budget, and I figured out my budgeted cost of direct material purchases. I just plug that in and I pull that cost because everything should be formulaically driven, right? Now I'm asking myself, how much do I pay for that during the quarter? Well, I pay for 20% of my direct materials in the quarter that I purchase it. So I'm going to pay my vendor 0.2 or 20% of my $30 million of direct material purchases in the quarter that it incurred. And remember, I just have these sum functions going on over here. Now it tells me that 80% is paid the quarter following the purchase. So again, I don't have information for this 30,000, but I'm pulling it through because this should be based on quarter 4 of the prior period. So if you were working through a problem, you would have to be given this value, or you would have to be giving quarter 4 direct material purchases in order to calculate that, okay? So what we do have information for, though, is saying that, hey, in Q1, I had my 36 million in purchases. I have already paid for 20%. I am now paying for the remaining 80%. And I flow that through, and I just have my sums over here. So now I have my total cash paid for raw materials, which is the sum of the cash paid for during the quarter, which is Q1, plus the cash paid following this quarter, which would have been based on Q4. So again, I'm paying for materials that I purchased last quarter and materials that I purchased this quarter for the total of the two. So now, again, what's important is it tells me that all other expenses are paid for during the current period that I incur it. So that tells me that there is no calculation needed for any of this. All I have to do is say, hey, I'm going to go to run my direct labor budget, and I'm saying that I am paying for all of my direct labor in the period that I incur it. So all I have to do is flow that through. Manufacturing overhead, I'm going to start there and then take care of this depreciation piece. So everything for my manufacturing overhead is paid for in the period in which I incur it. So I'm going to go grab that and flow that through. Now, though, I have a depreciation piece because remember, depreciation, I recognize depreciation expense of 15, and I throw that in my accumulated depreciation as a credit for 15. Nowhere in a journal entry for depreciation am I touching cash, right? It's kind of that made up accounting concept that we're just recognizing the reduction in value as I'm using up an asset. So when I'm looking at how much cash I have paid, well, I didn't pay anything for depreciation. So I have included 15 million of depreciation in this, but I didn't actually pay cash for it. So I need to back that out. Okay. So I'm going to remove this $15,000 in depreciation per quarter because, again, it doesn't represent an actual cash flow. And here I'm trying to understand my budgeted cash payments, and there was no payment made for this. Okay, so another way to look at this is I had actual cash payments of $14,515. Okay, but I had total expense of 29 because it included an expense of 15 that wasn't actually a cash expense. Okay, so now these last two are easy because the cash paid for selling general and administrative expenses, well, that's equal to the expense during the period. So I just go and I flow that all the way through. Now I have cash paid for equipment. So this last bullet point down here tells me that management plans to invest in a new slab forming equipment during Q1 at a total cost of $300,000. So they're going to pay 50% down or $150 million in Q1. So I'm going to put that information down. I have cash going out the door of $150 during Q1. Now I'm going to pay the remaining balance over the next 3 quarters in $50,000 or 50,000 million installments. So I will plug that down and I will see that I have my budgeted cash payments here because all I've done is said I had some sort of intermediate calculation to get my cash paid for raw materials. But ever since then, I was just plugging and chugging from the information that I had that I prepared during my operating budget. So again, you have to understand the connectivity of these because if you get a little bit messed up in one of these, it's going to really mess up all of your subsequent budgets, right? Because say I pulled through the wrong value right here and say I only, instead of 18,000, I fat fingered it because I hard coded things and I only pulled in 1,800. Well, that really messes up my total budgeted cash payments because I would be budgeting for paying $244, but if I actually was correct here, I should be paying $260. So you have to be cognizant, like when you're building out these budgets, of just how interconnected they are. Okay. So why we go through the process of doing my cash receipts and my cash disbursements is because, of course, and you can check this out here if you need to reference anything that we've done, we ultimately need to aggregate this into my cash budget. And my cash budget will then be aggregated into my pro forma balance sheet. So the final step in preparing the cash budget is to combine the cash receipts and the cash payments with the beginning cash to determine whether managers will have enough cash to pay their obligations or whether they need to borrow money to finance their operations. So it tells me that my cash on hand at the beginning of Q1 was $108 million. So I'm going to plug that beginning cash balance in. Now notice it only gives me beginning cash balance for Q1. How do I calculate these ones? Well, isn't it just going to simply be my beginning cash balance at the beginning of Q2 is equal to my ending cash balance from the end of Q4, or Q1, excuse me. So all I have to do is flow those through and I will be pulling through the respective ending cash balances and making them my beginning cash balance. Now these will change, right, as these numbers begin to change because it's a cell reference, okay? So now all I have to do is add in my budgeted cash receipts. So I get to go add my budgeted cash receipts, which I flow through from my cash receipts budget. And pull that all the way through. Now again, notice that this balance or all of these balances changed because this was added, which affected this cell. Okay. Now I need to subtract out all of my budgeted cash payments. So I'm going to throw a negative sign in there, right? Because I need to negate it. And I will just go grab my budgeted cash payments. Flow that through. So now the only other thing that we need to consider is any sort of cash borrowed or repaid for during the period. So I'm going to read and I'm going to see the company wants to maintain a minimum cash balance of 100 million. Okay, that doesn't really tell me anything about that, right? Other than I'm looking at this and I'm saying, well, they don't have 100 million, so I'm going to assume maybe they need to borrow. Okay. The company has a floating line of credit with the bank where it can borrow and repay cash in increments of $1 million. No interest is charged if the loan is paid off at the end of next quarter. Okay. And the balance in the loan at the beginning of Q1 was 0. So that's telling me that I don't have any interest expense charges because I didn't have a balance. Now, finally, this is what's important, is it tells me that I borrow $40,000 in cash at the beginning of Q1, and I pay it back during Q2. So again, I borrowed it, it increased my cash. I paid it back, it decreased my cash. And I didn't have any borrowing activities in Q3 or 4. Okay. So notice again how important it is that these budgets that we prepared before this budget are correct, because otherwise, if they're not, well, none of these values are going to be right. So why do we prepare our cash budget? Well, of course, is to prepare our budgeted balance sheet. So just like all of our operating budgets help us create our pro forma income statement, all of our cash budget helps us prepare our statement of financial position or our budgeted balance sheet. So you can see here, and really we don't have a lot of information to build this, right? We absolutely could, and let me make my Excel a little bit bigger as we walk through this. What we're saying here, and I did go ahead and build this out, but it's telling me that I have all of my assets, which need to be equal to my liabilities plus my equity, right? My balance sheet is just simply my accounting equation. So you can go through and build out. Remember, this cash is going to come from our completed cash budget. So at the end of 2024, we better have $295 million in cash. My accounts receivable, for the most part, is based on, hey, how much cash am I receiving and what is outstanding at the end of the year, right? How much do my customers owe me? My raw materials inventory is, hey, how much? How many pounds of materials do I have? How much did I pay for them? They sit in an inventory account because I haven't expensed them as cost of goods sold, and that's an asset to me until I go through that process. My finished goods inventory is the exact same idea, and it tells me my property, plant, and equipment. I have what I owe people, my total owner's equity, and then I get my total liabilities and owner equity, which is equal to my total assets. Okay, so here you can see just the total budgets that are needed for the income statement. They're all interconnected because we have our sales, production, DM, DLOH, aggregates into my cost of goods sold. I have my SG&A. All of that is used for my income statement. I have my budgets for my balance sheet, which are going to be my cash receipts, my cash payments, ultimately aggregated my cash budget, which then allows me to calculate or plug in that cash balance piece right there in my budgeted balance sheet. So really, why do we go through this process? Because we need to communicate organizational goals, motivate employees to achieve results, and just have a benchmark, right? Because imagine if you or companies or whoever just never budgeted, we would never know, like, hey, are we doing a good job? Are we meeting expectations? Are we exceeding expectations? So a budget gives us a place to come in and evaluate how we're doing and make sure that we are setting ourselves up for success. So just as a reminder, you will have a master budget project that is due in this class. There are instructions in Canvas, but if you have any questions over it, this is going to be the best kind of like point of reference, this video of building out budgets. But if you have any questions, please feel free to let me know because as always, I am very happy to help. So let me know if you guys have any questions. Otherwise, I will plan on chatting with you soon. Have a good rest of your day, and we'll be talking soon.